The QDII initiative is expected to somewhat ease the pressure to revalue the yuan, but only somewhat. In his trip to Washington last week, President Hu Jintao made it clear China has no intention of altering its measured pace for yuan revaluation. When China began its revaluation of the yuan last July, it stood at 8.27 to the US dollar. Now it stands at just about 8 even, strengthening a little more than 3%. That's not nearly enough to appease the hawks in the U.S. who feel that the yuan is artificially weak, contributing largely to the $201 billion US dollar trade imbalance between the U.S. and China. But during President Hu Jintao's trip to the U.S. last week, while making efforts to reassure the Americans that intellectual property piracy would be tackled and efforts would be made to address the trade imbalance, Hu was firm in his position that the renminbi revaluation will be done slowly, over time. I met with Asia-Pacific economist Andrew Freris and asked him if it was even feasible for China to drastically revalue the yuan the way the U.S. wants.
Everything is doable, but the question is would it solve the problem? In other words, the revaluation is there effectively to solve the bilateral trade surplus. Now, the Americans ran last year a deficit of about 730 billion, 725, of which the Chinese accounted for 200. Now, I'm not quite sure if the Americans want the 200 wiped out. That means the Chinese simply stop exporting and they only import from the United States. Well, that ain't going to happen. Now, what else can it happen? Is a revaluation so significant that within, let's say, 1 to 2 years, that thing really shrinks and shrinks significantly. And I have a terrible feeling this is not going to happen either, because it will require, to quote a rather jaded expression, a mother of all revaluations, and the Chinese are not going to do it. They're not going to do it because, of course, the United States is not the only place they trade with. We tend to forget, as if China only trades with the United States. China accounts for about 20% of China's exports. Well, what happens to the other 80 exports? 80% of exports. It's completely forgotten.
Now, the revaluation last July hasn't moved much, about 3%. Has it had any significant impact at all?
Well, sort of. Okay, to the extent that the first 2 months are telling us something about the bilateral deficit with the United States. It has grown a little bit worse, but not as much worse as it was getting compared to last year. But then a lot of things have also slowed down. Now, to give you an example, if I was to take the first quarter of this year, January, February, March, and if I was to annualize the Chinese surplus, okay, that was a big surplus, it's already smaller than it was last year, but not smaller in relationship to the United States. So in other words, the Chinese are exporting less, but it's not because the renminbi is 3% more expensive against the US dollar.
Isn't it cheaper for the U.S., though, just for the consumer, to have all of these Chinese goods coming into the U.S.? Isn't it, in a way, driving consumer spending in the U.S., which is good for the U.S.?
Absolutely, and this is the other aspect. You know, one feels sympathy about the people making pine furniture in North Carolina and the people that are making ladies' foundation garments. I understand this is a family show, so I cannot actually say the word again. Ladies is underwear, all right? One feels sympathetic when they lose their jobs because of Chinese exports. Yeah, but then equally one has to feel sympathetic about the millions of Americans that now have access to inexpensive clothes, to inexpensive shirts, to inexpensive children's wear, and I don't want to make it a little bit even more tragic. All the old people that can buy nice warm clothes made in China. Now, if you revalue by 20 or 30 or 40%, okay, well, they will not be able to do so anymore. So the interest of the wider interest of the 200 million plus American consumers presumably are going to be sacrificed for the interest of a relatively small, literally a handful of American industries. But I over-dramatize it, and possibly it needs over-dramatization. A, because it's not going to happen. In other words, the Chinese are not going to revalue, so this is not going to come to pass. And also because all this conflict contains a very substantial amount of politics and relatively little economics.
There still is the huge trade imbalance, though. Is China doing enough to address that?
I would like to stand the question on its head and actually revert back with a rhetorical question. It is not, is China doing enough? Is the United States doing enough? And the United States is doing absolutely nothing to narrow its gap with China. So in other words, it's all China's fault that the Americans are buying quite a lot of Chinese goods. The question, of course, the answer is yes, because they are cheap, or they are cheaper than they should be. Now, of course, the question is if the Chinese were to stop exporting textiles, and incidentally, textiles is not the major export of China, it's electronics, but that's a different question altogether. If the Chinese were to stop exporting it because they're more expensive, guess what's going to happen? The Americans will not stop buying them. They will stop buying them from Mauritius, from Guatemala, from Outer Mongolia, all other places. So the Chinese problem will go away only to be substituted by another problem. In other words, the Chinese are not a problem. They are a very small part of the solution. The major problem is the United States.
Now I want to turn the conversation to China in particular. The economy grew 10%, 10.2% in the first 3 months of this year, higher than China's own target. Is there signs that the economy is overheating?
No, actually there are no signs, and the signs of an overheating economy will be accelerating inflation. And inflation in China has accelerated, thank God. Okay, although we had a very low number last month. It has been accelerating, and I think it's going to go from less than 1% last year to about 3% this year. And one of the reasons is going to be deregulation of oil prices, which is very, very important. But if I'm looking at an economy which is growing at 10 to 11%, it won't. It will grow between 9 to 9.5%, with an inflation rate which is roughly equal to that to the European community, or even it is even less potential than that of the United States. My reaction is, sorry, where is the problem? There is no problem whatsoever. High growth with low inflation.
Andrew Ferris, Chief Economist with BNP Paribas. And that is Money Magazine for this week. Thanks for joining us. Good night.